It's time for our monthly catch-up with Shawn Burns, the fund manager of CIE, the Contango Income Generator Fund. Thanks for coming on, mate.
Pleasure, Peter.
Okay. Why don't we talk about the portfolio performance of CIE?
Yeah, in the last month we had a strong month, so up 3%, and the pre-tax NTA now is up to over 96 cents. So that's good. So that's the value of the fund, of the shares in the fund. I'm happy to see that. What drove that was, I think, a lot of CIE is sort of middle Australia in terms of companies, like a big exposure to Australian franked, because we're after franked dividend as much as we can. We have a skewing towards medium-sized companies. They all started to do better after the election with the expectations of tax cuts and interest rate cuts. That we had a lot of our lease companies and some which are exposed to a bit of activity in the economy, starting to get a bit more optimistic viewpoint on those, which is good.
Okay. So you sold out of the Dulux Group and it's been a strong performer. So tell us why.
Well, they had a huge takeover made for them from Nippon Paints. Nippon has tried. We've held Dulux in the portfolio since inception. It's a quality company and it also has yield and some growth, modest growth. In fact, it has a lot of the attributes we like to see in the CIE stock. A great brand, Dulux, one of the most trusted brands. It's delivered fairly consistently without a lot of volatility. It's well run, and the dividends have been growing modestly over time, but positively, which is all good. Then Nippon Paints tried a couple of times to get in the Australian market. No one can actually make much inroads against Dulux, and I think that at the end they've given up and bought they like the company, so they bought the whole company.
The old Victor Kiam line. Yeah.
That's right. So at a good price. So yeah, we're happy to take that price when that came.
Okay, so interest rates have gone even lower than last time we talked. So what effect will low interest rates have on your portfolio?
There's probably two main things to think about with low interest rates. The first is that low interest rates increase valuations, and so that's good for equities generally, and good for CI's portfolio because we do target companies that have yield, and so that will become more sought after. The other is lower interest rates are coming because of low activity, so some of those companies that depend on a lot of activity will suffer. But also that low interest rates may engender activity in the future. So we'll see whether that happens. So it is positive for the portfolio.
Yeah, and I guess people who historically haven't been your rivals in chasing dividend-paying stocks, they've now come to the party, which have driven up the share price of all of the stocks that you're already holding.
Yes, yeah, that's exactly right. I saw some growth managers overweight REITs at the moment. We big holding in REITs. With the Aussie bond down under 1% now, 10-year bond, if you think about that, that's you've got a stock which is solidly contributing 4 or 5%. That's quite valuable in that world of 1% rates.
So what's your outlook for the portfolio leading into the end of 2019?
I think we've still got to get through this result season. It's been pretty benign so far, actually better than what I've expected, but the big bulk of companies are yet to come. And so we'll see how we get through that. There could be a couple of misses because the economy was weak earlier in the year.
Yeah, and the election as well was no help to the companies you've already pointed out.
Yeah, that's right. So we need to get through that, and then we'll see whether low interest rates and tax cuts start to get a bit more stabilisation and activity in the Aussie economy, which will help the portfolio. That's what I think will happen, and we'll see how that pans out for the rest of the year.
Okay, Shawn, thanks for joining us.
Thank you, Peter.
That's Shawn Burns, the portfolio manager of CIE.